Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, November 14, 2022. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Let's go through both the upside and the south side. We're going to talk about what's on the docket this week. Where does the market begin to fall apart? Where does the market begin to accelerate on the upside? What's the bigger picture? We've got some holidays coming. We have some cycles culminating. We have all kinds of stuff to discuss. We're going to refresh our memories with everything on the board. What's jumping off on the page or off the page from the daily chart? The first thing we notice is a low, a higher low, and here we are in the midst of, and not finished yet, but in the midst of completing the inverse head and shoulders pattern. Now, we said they could go to two prices. One could be the big fat round number of 400, and the other one could be around 405. I'm going to show you tonight, as we did last week, why there are some higher targets. Now, there's the neckline of our inverse head and shoulders formation. Left shoulder, we've got the head, we've got a little right shoulder, we've got a breakout, and it really takes us to a minimum target, which we've already achieved, of about 400, likely more so in the 405 and maybe even higher neighborhood. Now, let's talk about what's up there for a moment. You have the 200 period moving average. From the daily chart perspective, it's the last moving average line of defense. It's important, they become magnetic, and price gets sucked in the closer they get. So we got rejected today from SPY 400. Is that normal garden variety market behavior? And the answer is, of course it is. On the first run, they touch it, they get rejected, and that's the end of it. However, is that the end of the rally? Well, it's unlikely, but what happens if it is? How will we know? What numbers do we have to be looking at to know that we have no business looking at the upside until they're back above some number to be named later? But the most important thing right now is, where does that market fall apart? What's the line in the sand in the southbound lane? For now, we're going to notate 390.40. Why is that? Because that's the last breakout area in the sequence. The market ran up to that spot, was summarily rejected to come down and retest the neckline of the inverse head and shoulders, and then made a subsequent move to the upside. So if they recapture that in the southern direction, that's going to be a negative sign for the bulls. That's going to turn the bears into holders of the short-term torch. Now, let's say, for argument's sake, they got below 390.40. Then what happens? Then the next number in line would be the low of this breakup candle, 385.64. And you can see if they start getting below that from an intraday perspective, closing candles below, hourly below, and then daily below, well, then it opens the door down here in the 380, 375 neighborhood. There's a gap down there. There's a whole nother situation going on if they start getting below 390.40. So do this. Put 390.40 on a sticky note. Remember it. For the bull case, they shouldn't be below 390.40. Write that down. What else is on the docket this week? Well, we've got options expiration. It's regular way options expiration, not the weekly stuff, not the daily stuff, not even the hourly stuff. Who even knows if they have options expiring by the hour these days? That's just the casino stuff. This is the traditional regular way options expiration, the third week, the third Friday of each month. So this week, we can expect the unexpected. And here's what we say each and every month. Weird stuff happens. Don't be surprised to see the market taking a dip. Don't be surprised to see the market making a pop. Don't be surprised to see both things each day, or at least some of the days, similar to what we saw today. We'll get to today's intraday activity a little bit later. When we look around the horn at some other charts in the SPY itself, we notice a couple of important things. On the 240 chart, just so happens that right below the 390.40 comes in the 200 period moving average on the 240 chart. Now, think about this for a second. From a short-term perspective, the market's in an uptrend. Nothing moves in a straight line. Market goes up, it pulls back, goes up, pulls back. In a downtrend, goes down, rallies, goes down farther, rallies. That's the way it works. So here, if we are in a still bona fide uptrend and the market's in the midst of a pullback, coming back to check in at the last moving average line of defense that they busted through would be garden variety of support in addition to and because of the same 390.40. So you begin to see or create or build a full stack situation when you start looking around the horn and incorporate other things from other charts. How do you like dem apples? Speaking of apples, when we flip over to the 120 chart and use the same information, what do we find? Well, same routine, only flipped around. We find the last line of defense in the moving average business around the 20 period moving average, or what? You got it, home base. The market never likes to get too far away from home base. We haven't talked about that in a while, but those of you that have been around a while will remember that. So here the market comes back to pay a visit to home base. Home base exists on all the charts, all the time frames. Now we have the 240 chart and the 200 period moving average coinciding with the same 390.40, same number, and the 120 chart and home base or the 20 period moving average right around, give or take, the same price. You see, we begin to build a case / full stack for a bounce back in the other direction, assuming for a second, and we don't want to assume anything, but for the purposes of this conversation, we'll assume, and you know what happens when you can assume, you make an ass out of you and me, but nevertheless, we can assume that the uptrend when we have this discussion is not necessarily over with a capital O. Let's now do the inside the number thing. We're going to run through some of the commentary. We will circle back to stocks on the move. We'll, of course, look at the good, the bad, and the ugly, if the ugly exists. It does not. Let's set the table for the day. It's Monday, after a big bang last week with stock markets ripping higher in an effort to complete our inverse head and shoulders pattern. So from a minimum perspective, we can say they pretty much did that, but we also built the case for some higher stuff. We're in an uptrend, all that stuff. All set up by the slight downtick in the CPI print, meaning the CPI ticked down a little bit, just like nothing goes in a straight line. Price goes up, price goes down. CPI goes up, CPI comes down. Doesn't mean it topped out, but yet the market wanted to hear that. Therefore, the market wants the participants to believe, or the participants want the market to believe, or the participants, which is the market, and there's a correct thing to say, wants the media to believe that a slight downtick in the CPI data print is fair game for new highs coming in the market. They would like us to believe that inflation has completely finished going higher, and therefore the Fed has now saved the day by raising interest rates to the point when they've stopped inflation. That's the prevailing wisdom when you see the market ripping higher in one of the largest days up ever. So what I wanted to point out this morning, just so we're all on the same page and we have a grounded understanding of what's going on, is anyone's grocery or fuel bills reflected in the CPI number from last week? And the short answer is, of course not. It was made for TV. Now on for the numbers for today. Let's start with what they chose to do or not do on Friday. The decision was made not to get to the next big fat round number of SPY 400 on Friday. However, the futures did their respective fat number. I like to call them the big fat round numbers. Therefore, the fatty of ES 4000. They did that last week, came up short of SPY 400. They do that kind of thing. We talk about it all the time. And the reason we talk about it all the time is because they do it all the time. That's what's called a feedback loop. 397.50 is important and will serve as our early bull-bear pivot. Staying above keeps the band playing on and the door open for a continued push higher to where? Above 400, of course. However, below, the door opens for a battery of tests. 396.40 is the first one. Next up would be lower, 394.70, which is magnetic and likely supported by buyers. 394.70. Let's get our faculties. This is what's on the page. Right of the vertical is today's activity. The top line is 397.50. That was the pivot. You could see below, they stay below, get above, and they pop a little bit, and they trade around it all morning long, and you can see them continue to test it and retest it. Stay above, they rally to 400, which is up here. You see at the top, the high of day was exactly 400.17. Once they get below, and you can see this test later in the afternoon, look over here to the right. They come down, 397.50. They try and hold it. They bounce off of it a little bit. Once they give it up, that's it. And then what did it actually open the door for? Look down here. They didn't quite get there. They came within a few pennies short, but 394.70. And as you can see, low of day really into the closing bell was 394.83. That's low of day, low in the last candle of the day. So they almost got to that important number right at the closing bell. Pretty interesting how that worked out. We laid out the entire thing with the numbers before the opening bell. It pays to know your numbers. All right, let's see what we had on the board. So what have we got today? 397.50 remains our early pivot. Staying or getting below opens the door for 396, give or take. We had 396.40 before. I'm lowering it to 396 as we get closer to the opening bell. I want the lower numbers. I want the better prices. Back to the chart. 396. What happened at 396? They bounced right up and they had a nice rip-roaring rally away from it. So here it is. The high was 398.97 before a pullback. So call it 399 from 396. That's 30 handles. The low in the morning was 395.92 against what? 396 right here. How you doing? It's a price area that can be met with some folks representing the buy the dip crowd. Below is a real-time type of thing after the bell rings. Above the pivot, that was 397.50, and the door opens for at least 398.50 for starters. So you know what happened now. Let's lay it out. And this is all before the opening bell. What happened was 396 was support, 400 was likely. That was on the board bright and early. We had the pivot of 397.50, and there it is. Therein lies your entire schematic for the day before the opening bell. Pause the video, read the notes, go back to the chart to double check the work. The concept is this, 921. Since 397 is our pivot, if they drop them, they'll be back for a visit. They did that. They came back for the visit. If they're above, they'll keep going. I'm not interested in the short at 398.50. This is that morning trade concept because we're in the uptrend. That's what I lay out here. Right now, the uptrend is intact, so I'd rather be a buyer with the buy the dip crowd rather than fighting the trend. That's where the odds favor success. So we're going to be a participant with the buy the dip crowd if they give us at least 396, give or take. What did they do? How you doing? Pause the video, read the notes, go back to the chart to double check the work. This is your tour guide information each and every day. I've got the numbers, not 100% of the time, but I certainly have them most of the time. I know if price is above, one thing is going to happen. Again, pause the video and double check the work. Don't get mesmerized while the screen is scrolling and I'm talking. Do the homework. What we do know is below one number and they go to the next number below in the southbound lane. Above one number, they go to the next number in the northbound lane. That's what we talk about early on. Then we watch it happen. We know where our exits are because we know where the next important number is, and we can always hold a trailer for the just in case. We had some stocks on the move today. Let's take a look at the chart of OKTA, NET, and the last one on the list, Hasbro. First one on the board was OKTA, $52 even was the number. They came into it, they spiked it by a few pennies, ripped it back in the other direction. The high was $53.20, a $1.20 rip after they came into the number. The low here in the morning, right when they did it, was $51.95. Next up on the list was Cloudflare, NET. $51.50 was the spot. They spiked it, they bounced, they stayed above it. The rest is history. The numbers work. How about Hasbro getting a nice haircut at the open? So this is what this one looked like. It opened below the first number, below the second number, so they're off the board. They're not considered any longer. They're no trades. The third number was active. They opened, they spiked it. $57.95 was the number. The low in the first candle of the day was $57.61. They ripped back up in the other direction. The high was $59.52. Nice trade. See you later. Bye. Once again today, from a stocks on the move perspective and an SPY perspective, we had what I like to call the cadence. What's going on over in Camp IWM? Pretty simple stuff. They spiked the 200 period moving average after a tremendous rally last week. Now they're just pulling back a little bit. Now let's talk about trouble, or where they get into more trouble. So they've already come back to recapture the most recent breakout area, but think about it for a second. They only broke out of it for a day and a fraction. So therefore, maybe, just maybe, they need some more pullback situation. We're going to use, in this case, the big breakup candle as the line in the sand, which is the low. So if they pull back and they go back and forth for a few days inside the breakup candle, the last breakup candle in the sequence, where the low is 181.15, that's okay. They'll stay above these moving averages, the 120 and 50 period moving average, build some energy to make another push higher. There's a bull and a bear case with the IWM. The bear case is they filled this gap over here, and the gap existed from September 12th, and the closing price here was 189.67, and where I consider the gap filled, which is the end of the white space, was filled. That comes in at 188.60, and the high on Thursday was 188.84. Friday, pardon my day late. So you think about it like this. They fill the gap, they're going to get rejected at least for the short term. If they get rejected a little and eat time off the clock in a pullback formation, they'll be building energy to make another push higher. If they pull back more, then it was likely a more important top, and we won't really know that until or unless they start getting below the low of the last breakup candle in the sequence. That gets into the white space, the moving averages, and the gap down here. That changes the makeup of the tape, at least in the short term. The other side of it is, rather than a pullback, the other side is, well, they haven't yet on the weekly chart run into or ran a test of that 50-week moving average. What's the likelihood they won't do that? They should do that. They normally will do that. However, there's nothing that says they can't eat time off the clock before doing that. What about the folks down at the transportation department? Now, they've been ahead of the crowd. Look at this chart in comparison to the other ones we've looked at. This is a very, very strong chart. It's my favorite canary in the coal mine, my second favorite market leading indicator. But look what they did. Let's look at this thing objectively. So they've taken a run for the big fat round number of 15,000. They haven't got there yet, but where did they get to? They got to the vicinity of the breakdown candle high. They didn't quite get to the top, but they don't have to quite get to the top. They almost got to the top, and now they've put in what we like to call, in the trading parlance, a topping tail. Now, a topping tail is a signal or sign of a trend change. It can certainly signify a pullback. How much of a pullback? Well, they don't tell you ahead of time. Staying above all the moving averages would be the bull case. Getting below the 200 period moving average, below this 14,223, give or take, that would be somewhat of a more bearish, at least in the short term case, for more of a pullback. You have a big time breakup candle. If they want to start running some tests down below, inside that candle down to 14,000, the last breakout area in the sequence, which comes in right here, which is right around or below 14,000, that is certainly garden variety market behavior. What about the Q people? 293.50, they haven't got there yet. They should get there. That is a target. Not getting there is an extremely bearish case. Write that down, put it on a sticky note. Staying above 282.50 is also important for the bull case. Put that on a sticky note, not the same as the other one, a different sticky note. Weekly chart perspective. Now this is small, but it's something. Low, higher low, target happens to be somewhere in the vicinity of the 200-week moving average, home base, bullish finish to a bullish week last week. They should have more on the upside at a bare minimum. Once they can get, if they can get above that 20-week moving average, what do they start doing? Well, then they start climbing the next big breakdown candle in the sequence right over here, and that opens the door for what? You got it, the next big fat round number in the sequence, QQQ 300. Staying with the weekly frame, XLF, the financial business, they went into the convergence of the 50 and 100-week moving averages, which also coincided with running a test of a former pivot high that was rejected, or at least price was rejected at that number all the way back down. Here we are again. Did they come back to run a test of the same spot and get rejected again? Or are they going to get past this spot and have another leg higher? Remember our discussion, they got to and beyond our target. A target is an exit for traders that are long. It's not a short trade. The target was filling this gap over here, came in at 35.60. They went up to 36, the next fat round number in the sequence, and now they're pulling back. Doesn't have to be the end. If they stay above all these moving averages, they'll be just fine. Pullbacks happen. Markets go up, they pull back. They go up, they pull back. In a bear market, they go down, they rally. Into where? Resistance. Then they go down again. Talked about this before. Same rules apply, different chart. Smash mouth. First thing I see on this chart, 200 period moving average should be magnetic. Price should get there. They don't have to get there tomorrow. They can get there tomorrow. They can pull back for days and then go. Eat some time off the clock first. But here's what you need to know from an important number standpoint. Best case scenario is staying above 212.5. Start getting below 212.5, then they're going to start testing the 100 period moving average. Start doing that. They're going to want to run a test of the breakup candle low. Start doing that. They're going to want to get below, fill the gap, all that stuff. Best case scenario is for the bulls, stay above 212.5, no questions asked. If they do that, they'll eventually get into that 200 period moving average right around 228 and change. It moves every day. Have I told you how much I appreciate each and every one of you? Without you, these videos are not even possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.